Are you wondering which is better, a 401k versus a Roth IRA versus a traditional IRA? How do you choose between them and maximize your tax advantages for the long run? That's what we're going to talk about today. And you're going to want to stay tuned because we're going to talk about some things about the Roth that you probably didn't know and ways that you can contribute no matter how much money you make. We'll also take a look at taxes in a way that you've probably never seen them. So this one not only can increase your retirement income, it can add years to your retirement. And you're going to want to stay tuned till the end because we've got a special offer for you.
Hi, and welcome to Retirement Planning, tailored specifically for medical professionals. In this video, we'll break down the essentials of 401ks, IRAs, and Roth IRAs. First, let's talk about 401ks. A 401k is a retirement savings plan offered by many employers. The contributions are tax deferred, which means you don't pay taxes on the money until you withdraw it in retirement. I want to mention something really important here. We have no idea what taxes are going to be when we retire. Number two, when you're taxed, this is taxed as income, just like when you're working. In a 401k, you have deferred, or I say postponed, the income. Therefore, you've deferred or postponed the income taxes. This is not looked at as any other type of income other than earned income that year. Next, we have IRAs, or individual retirement accounts. These may have nothing to do with your work, and the contribution limits are much lower than a 401k. There's two main types of IRAs. There's traditional IRAs and there's Roth IRAs. So traditional IRAs, again, offer tax-deferred contributions. What that means is that it lowers your income that you're taxed on. Just like a 401k, you're deferring or postponing this income and the taxes that go with it until you start taking the money out. So Roth IRAs do not offer tax deductions, but do provide tax-free withdrawals in retirement because you pay the taxes on the front end. So let's put this in the form of a picture. Each of these buckets is a type of plan. Notice that each of the buckets may or may not have holes in it. Those holes represent the taxes leaking out. Taxable is taxed every year. Tax deferred is the taxes that are postponed till later. And tax-free means you pay the taxes up front and will not pay taxes later. So based on the way they're taxed is how many holes are coming out of the bucket. Okay, so here are our three buckets again. Notice I've put in them items based on their tax category. Taxable is cash, checking, savings, CDs, stocks. Tax deferred or postponed are 401ks and IRAs, 403bs, which are like 401ks for certain sectors, and savings bonds. These are what we're talking about today. Then tax-free, or I say tax-advantaged, like a Roth IRA, 529 plan, and we had muni bonds in here, but there's some caveats around those that we want to be aware of. So let's look at this like a tree. Taxable is like cutting a significant branch off every year. It still grows, but it's being reduced by taxes every year. In this case, $100,000 at 9% over 20 years gives you $340,000. Not bad, but what if we didn't have to interrupt the compounding by cutting off a big branch every year? Now, you may ask, Allie, where can I get 9% every year for the next 20 years? Well, this is an example because I used to do these dinner seminars for doctors, and there's always somebody in the audience that was getting more than what I said, and they finally quit asking questions once I said 9%. So we're saying 9% over 20 years. Notice the taxable, it's cutting a branch off every year. So in the end, we end up with $340,000. Okay, so we're interrupting the compounding each year because we're paying taxes. So what if we don't have to cut off a big branch each year? That's our next category. We paid no taxes up front, and it grew over 20 years to $500,000. Sounds great, right? Except we have no idea. I'm going to say it again. We have no idea what the tax rate will be. That's the kicker. In my webinar, 9 Money Mistakes Medical Professionals Make, I go deeply into the implications of how this can affect your retirement. So the third category here is tax-free. I say tax-advantaged. Notice we took out tax on the front end. We started with the $70,000 uninterrupted, $70,000 because we took the taxes out of the front. Now we've got $70,000 compounding uninterrupted at the same rate. In this case, it gets to $400,000. This may not seem like a big difference, but I'm using today's tax rates. So not the unknown rates of the future. That's like saying bread is going to be the same price when you retire. This is a huge oversight in the financial planning industry today. So if there's one thing I can tell you, it isn't about the big pile of money. I'm going to say that again. It isn't about the big pile of money. It's about the timing, the combining, and the sequencing to stretch it as far as it can go, following the tax rules, etc. So this is not the information that's in the mainstream. Executive in corporate America, I never paid attention to the Roth. My earnings were too high to contribute, and the key word there is to contribute. Right now, there's a different way that you can participate, and that's by rolling IRA funds or 401k funds into the Roth and paying the taxes. Note, you may not be able to do that with a current employer 401k, but the rules can be different if you're 55 or older at a current employer. Now, you can do it with an old employer 401k or an IRA, okay? So my story around that was when I was leaving the corporate world, that job, they had been putting aside some money for my retirement each year. It was like 4%, something, it was not a big amount, but they'd asked me in the end how I wanted to take that. And I said, you know what? I want to check. So I'm sitting out in the front yard one day, UPS guy shows up and he hands me an envelope. I'm assuming it's a check. I open the check and the check is for the whole amount. And I thought, well, isn't that interesting? They didn't withhold taxes. I didn't instruct them to withhold taxes, but I thought, you know what can I do with this whole check? And what I decided to do is exactly what I'm telling you. It went from a qualified plan, like a 401k IRA, and I rolled it into a Roth. And what I did was I rolled the entire amount into the Roth and I paid the taxes out of other funds. And you say, why did I do that? Well, one, I didn't want to stunt the compounding. I already had this check. Let's just say it was $100,000. I had this check for $100,000. Why, if I could pay the taxes out of another account, wouldn't I do that and let that $100,000 compound tax-free forever? So that's what I did. And that was my first experience with rolling something into a Roth. So that's where I started now. And now at the end of every year, I'm looking at my income, and I say the end of the year because, each year is different in what you make. Maybe you got bonuses, something else. And what I'm doing is I'm taking that old 401k, old IRA money, and I'm saying, I want to take a sliver of that, a piece of it, and I want to roll it into my Roth IRA, go ahead and pay the taxes on it. And the key for me is looking and saying, okay, here's the tax bracket that I'm in. And I want to say, if I can take an amount that doesn't push me into another tax bracket, I go ahead and do that and pay the taxes. So I've been doing that for the last several years. And my personal goal is that in the next 5 years, there will be no more 401k money. There will be no more IRA money. Everything will be Roth and other tax advantage vehicles. Why is that? Well, because when I retire, if I don't like paying taxes now, how much am I going to like paying taxes when I'm retired? I don't want the government in my pocket. I don't want the IRS looking and saying this is counted as income. So what I'm doing is I'm taking advantage of that now. Now, what I would say is if you're in a very high earning capacity tax bracket, that may not be something that you want to do, but you may want to take a look at it each year because there may be years that you don't make as much as you did in previous years. So this is, it's just an option. And I look at this very differently than most people and most advisors. I've been studying this for at least the last 10 years on how to optimize everything by timing, combining, and sequencing. As I said, it's not about the big pile of money. That's my specialty. That's how I help people. So again, my personal goal is to have everything out of the taxable buckets by the time I'm retiring, say it's in the next 5 years. And let's say I'm still earning money. That's fine. That's going to be taxed, but I'm not going to be hit on my 401k as I start taking the income out. Okay. Many employers offer a match for your 401k contributions, and this is usually a percentage match based on what you save in your retirement plan at work. Let me give you a couple of examples. So one company may match dollar for the first 3% of your salary that you save. Could be 50% on 5% of your salary. It's kind of numbers like this. It's not unlimited, and it's based on you contributing. So guess what? If you're not saving anything in your retirement plan, you're not getting any match, okay? So I look at this as free money. And you say, okay, Allison, why is that free money? Because they're paying me to save, right? So the 401ks and IRAs, this all replace the old pension plans. They're trying to motivate you to save so that you do have something for retirement. And when I say it's free money, if you're doing it up to the match and you're getting the match, this match is going to offset what you're going to have to pay in taxes later on. So why not be compounding on a bigger number and being incentivized because you're actually saving something? So if you're not taking advantage of it, then it's your loss. And this happens on an annual basis. So you can't go back and pick up the dollars that you missed out on. So what we want to do is look and see if your employer has a match. If you're contributing, you should be getting some of the match. If you're not contributing, you may want to contribute up to the match just so you've got that money. If you can possibly get the match inside a Roth, and some of my SOFA clients that are employers, big employers in New York City, actually do that. If you can get the match inside of the Roth, that's even better, right? Because we talk about that Roth compounding tax-free. And so all we're saying is we're adding more to that bucket of tax-free income, okay? So make sure that you check that out. See if you're getting a match, if you don't have a match. And so my next slide here is just talking about if you haven't yet started a 401k or an IRA, and you have the ability to do that at work, you might want to think about that, okay? So there's differences whether you're saving in cash. We talked about that tree. We talked about the tree and slicing a branch off every year. There are benefits to deferring taxes. There are benefits into not having any taxes at all, but it's a holding place where you can put it until you decide what you want to do. So even if you're contributing to 401k and your plan is to roll it at some point into the Roth, at least you're saving someplace and it's accumulating, okay? So this is like planting seeds in the garden. The earlier you plant, the more time you have to flourish. Can you guys see that I'm a gardener? Definitely a gardener, lots of analogies around that today. So if I'd known back then, a long time ago when I was 20 years old, what I know now, right, I'd be that much further ahead. Now, I was lucky because my dad had said, okay, you got this 401k plan at work and you're going to contribute everything that you can. I was a college student and I thought, this is great. You know, dad's going to pay for pizzas and everything else at school. And he goes, no, I'm not. He says, but you're going to put in the max that you can and you're going to get the match. So some of the best advice I ever had. And, you know, I did that through my life. And what was missing was he didn't tell me where to put it, right? It's kind of how to invest it or what to do. So all he knew, and a lot of us know, all I knew until I left corporate America was really about the 401k, but understand that you've got other options. So many of you have got multiple plans because you've had different jobs. And what I would encourage you to do is you want to look at those. You want to look at those on a regular basis. Could be quarterly, could be semi-annual, could be annual. But just like your garden, you're going to want to look at those and be able to prune them and make changes to those so that you're ensuring growth. Now, I know our tendency is that we don't like talking about money. We don't want to look at those statements when they get dropped in the door. But if you're not looking at them, you might have somebody look at them for you and just figure out how can I make better moves. That's, you know, at the end of the day, like I said, we want to make that money stretch as far as we possibly can. If we can get the IRS out of our business on the taxation, that's even better. But we want to look at those. We want to look at that on a regular basis. Okay. So there are some really interesting things that we can do with your old work 401ks and IRAs that might surprise you and get you closer to what you want. Again, the idea is make that money last as far as you possibly can. So harvest time. What is harvest time? Harvest time. My definition of retirement is doing what you want to do when you want to do it, and it isn't dependent on a paycheck. Okay. The word retirement means we're put out of service. Well, none of us are put out of service. We're all going to do something. Most likely we're going to do something. But when I say retire, it's you making the decision at that point that I'm no longer dependent on a paycheck and I can do what I want and I've got the income coming in from the money that I've saved. So your retirement is your time to enjoy the fruits of your labor. All the work that you've done, all the service that you've provided over all the years, right? And I've got some pictures here of a tree that's full of fruit and a basket full of vegetables. So that's the goal, to do what you want to do when you want to do it. My goal is to help you get there however I can. Are you ready to take control of your financial future? I mentioned earlier that you can learn more to optimize your money and your taxes by watching our masterclass, How to Avoid the 9 Money Mistakes That Medical Professionals Make. I gave this presentation at a conference in San Diego, medical conference in San Diego, and I had a lot of positive feedback. But the biggest question was, why hasn't anybody ever told us this before? Well, it's a really good question because this information is not out there in the mainstream. Okay, I can pretty much promise that there's something in there about your money, you and your money, that you didn't know. What if, like an early diagnosis on a major illness, you could act on it and prevent it because you know it now? So there's information in there that's going to change the way you're thinking about your money now and planning for the future. What if you could retire or do what you wanted to do earlier than you thought? What if you could add $1 million to your retirement? You need to know this now, and I want to get it in front of as many people as I can. So go to www.medmoneymistakes.com. That's www.medmoneymistakes.com and watch the masterclass. You'll be glad you did. Thanks for watching, and we will see you next week.